If you're thinking of departing Germany tax-wise and become a tax non-resident, but you're not sure where to start, this video is for you. My name is Jelena and I'm a strategy manager here at Nomad Capitalist, where we help people diversify their options and go where they treat it best. Although you might think that tax non-residence is an easy process, there are a lot of things to consider before you embark on this journey. Usually, the process is very subjective and depends from individual to individual, although there are some rules that are applicable to everyone. So just remember, this is not tax advice. These are some of the general rules that can be applicable when departing Germany. The German taxation laws are quite complex, and simply deregistering yourself and your family in the city hall does not automatically mean you are not subject to German tax, although this is one of the most important steps. The whole process should be carefully planned to ensure the best outcome, and you should consult with a specialist to ensure a smooth process. So as mentioned, one of the first steps and the most important step is the deregistration. In order to deregister from the city hall, you have to give information that you are leaving your home and that you are not going to be a resident of Germany anymore, which means that you basically need to cut all of your ties with Germany. Now, some of the ties that can be relevant in determining tax residency and that you should cut or avoid having in Germany are definitely, one of the first ones is that you cannot have a home available to you. So you need to sell your real estate, or the less preferable route is to rent it out long-term at arm's length to a third party. So if you own an apartment or house in Germany, which you are not renting out full-time, you could still be seen as having your place of residence in Germany. Now, this does not even have to be a house or an apartment. Simply a room in your parents' house, which is reserved for your visits and has some of your personal belongings in it, can be enough to make you a tax resident of the country. The second thing you need to pay attention to is that you cannot spend more than 6 months per year in Germany. It is generally advisable to not get too close to the 6-month limit per year. So always make sure you spend a few days less there, just in case. As we always say, spending more than 183 days in a country will make you a tax resident. But merely spending 182 days does not necessarily mean that you are going to be a tax non-resident. So you should definitely be careful there. So the last thing you need to pay attention to is that you cannot have any income derived from Germany in the year of departure. Some other things that you need to pay attention to but may not be a big issue are bank accounts in Germany. By itself, they will not impose a problem, but you will not be able to use a German address for the opening of any bank accounts. If you have a German bank accounts, you should change the address which they are registered as soon as possible. You generally cannot use a German address on any documents, since this would mean that you're admitting to still be a tax resident of Germany. You can still visit Germany to see family or friends, and you can still, for example, have a doctor's appointment here and there, but again, you cannot be in the country for more than 6 months per year. One of the most important things to note and be aware of when departing Germany is the exit tax. When it comes to the exit tax, this is not a separate type of tax, but it is considered as income tax plus solidarity surcharge and, if applicable, church tax. Now, the exit tax would be applicable to you if you have held an interest of at least 1% in a domestic or foreign corporation for the last 5 years, or you have lived in Germany and have been taxed in Germany for the past 7 years out of the last 12 years. Now, how the exit tax works is that Germany will treat the departure as though you have sold your assets at a fair market value and repurchased them immediately after. But of course, you did not in fact sell, nor did you obtain a sales price. Nevertheless, the state requires you to pay tax. So as you can see, if you depart, you can be affected by the exit tax. Although the exit tax is due when you leave, it can in some cases be possible to pay the assessed tax in 7 equal annual installments upon request, so you can mitigate it to some extent and alleviate the tax burden. Now, the exit tax applies to the individual taxpayer, and it applies to the capital gains of shares in corporations that are held as private assets as soon as you, as a shareholder, move abroad and these shares are withdrawn from Germany's right of taxation. Now, in general, the exit tax is calculated in 3 steps. Firstly, the tax authorities will take a look at the fair market value of the shares at the time of departure. Then, the acquisition costs of the capital shares are deducted from this value, which results in the notional capital gain. The capital gain is then taxable at the personal income tax rate of up to 45% plus a solidarity surcharge. Now, due to the partial income procedure, in some cases, 40% of this could remain tax-free, and this could result in a maximum tax burden of 27% plus a solidarity surcharge and, if applicable, church tax as well. However, this is case by case and you should definitely check with your tax advisor. So let's say a couple of years pass by and you decide to go back to Germany and register again there. So in this case, you generally will not have to prove that you were paying tax somewhere else. However, you will have to prove that you were not a resident of Germany during that time, which can be tricky if you didn't have a place of abode anywhere else. If you register yourself in Germany again, you generally will not have to pay taxes on the years while you were away from Germany and were deemed a tax non-resident, as long as all the requirements for tax non-residency were met during that time. What you should generally take into consideration when departing a country for tax purposes is to not treat this as a temporary period. You have to show that this move is permanent, meaning that you're not coming back anytime soon, at least for the next 5 years. If you come back just a couple of years later, you might risk the tax authorities treating your departure as a vacation and claiming that you have never left. Therefore, they would want to tax you retroactively. One more thing to pay attention to is that if you're a parent of an underage kid, and your kid was of age to go to school at the time when you departed Germany, one important thing that Germany will check and will question you about is where your children have been going to school while you have been a German tax non-resident. Unless your spouse or yourself are teachers, it is not enough to homeschool them. Germany is strict when it comes to this, and you have to expect penalties if the authorities find out that your children have not been going to school abroad, nor have they been schooled by somebody with a teacher education. So in case you are leaving Germany, we would definitely highly recommend you to enroll your kids in school during your time away. Now, as you can see, the tax non-residence process can be quite complex with a lot of details to keep in mind. Here at Nomad Capitalist, we have a dedicated team of professionals to ensure you a smooth process when diversifying your options. If this is a topic you would like to further explore and see how it is applicable to your particular situation, you can apply to work with us on our website. Additionally, you can now join the waiting list for Nomad Capitalist Live, our annual event, which will be held in Kuala Lumpur this September. There you will have a chance to mingle with like-minded people and learn more about different processes.